Hello, Harry Shepler from Shepler Financial Group here today. I want to talk to you today about asset classes that make the most money in the market. Now, these are asset classes that have been determined by Nobel Prize winning research. And if you apply the scientific research, you will over time make more money. These two classes are small and value. And I'm going to explain what they are in a minute, but I want to tell you first that small company stocks outperform large company stocks by 2% per year. Value company stocks outperform growth company stocks by 4% per year. Now, small company stocks over a 10-year period of rolling average starting in 1926 all the way to the end of last year, if you pick any month and you roll the average forward for 10 years, small stocks outperform large stocks two-thirds of the time. And if you go 20 years, it's 84% of the time, small companies are going to do better than big companies. On the value side, where I said it's 4%. Over a 10-year period of rolling average, it's 81% of the time, the value stocks will outperform the growth stocks. But over a 20-year period, 97% of the time, on a rolling average basis, value stocks outperform growth stocks. Now, what is a small stock? How do we define it? Well, what we use is what's called market capitalization. Market capitalization is the number of shares that people own times the price per share. So if we have a company that has 1 million shares outstanding that people own, and the price per share is $20, the market capitalization is $20 million. 1 million times 20, we get 20 million, and that's what the market thinks the company is worth. Well, you can do this for every company that's listed on an exchange, and you can rank them from the largest company to the smallest company in terms of market cap. Now, what Wall Street does when they do this is they draw a line in the middle, and they say anything below the line is small and anything above the line is big. But it doesn't really work that way. The scientific research actually has 10 deciles, and there are 10 different boxes that small and large go in. So if you want really small companies, you're going to go down to the last couple of boxes, maybe the last 2 or 3 boxes, to get really small, and you can get really large by using that top 2 brackets of the deciles. Value is a little harder to understand, but it's important to understand. We know market cap. The other thing we can look at is the company always puts out once a year a annual report. There's a picture of the president and a little write-up by the president, and they tell you how good the company is and how wonderful their last year was. But then they get to the P&L and also the balance sheet. If you look at the balance sheet, it's the assets minus the liabilities, and what's left over is the net worth, or what many call the book value. Now, if you look at the book value of the company, this is what the accountants think the company is worth if you just closed the door, sold all the assets, paid all the liabilities, and whatever's left over is the book value of the company, which belongs to the shareholders. Now, what's generally the case is, almost in every case, the market cap, that is how much the market thinks the company is worth, is more than the book value. If you have a big discrepancy where the market cap is way up here and the book value is here, that's called a growth company. And growth companies could be like, well, let's see, certainly Amazon is a growth company, meaning that the stock price is way above the book value. And these small companies are generally companies we haven't even heard of. But the value companies are those companies where the market capitalization and the book value are very close. And you ask yourself, well, wait a minute, what is the market must not think much of this company because it's not valued much more than what you could close the door and sell everything off. So in truth, a value company, generally speaking, is a sick little company. There's something wrong with it. The market doesn't think much of it, but it's got the most potential for growth. You get a good manager in there, looks at the problem, turns it around, and all of a sudden the stock price can fly. So, and generally that's what happens. As a class, okay, the small cap value companies make on average about 12% per year. And so, that's a good premium over large company stocks, and which make about 10% a year. So overall, if you were all in value and small cap value, you would make the most money. However, you would also have the largest risk, almost by a factor of two, over the growth companies and the large cap companies. Now, most money managers will only invest in growth stocks and in large stocks because there's less risk associated with them, and they can't lose their shirt in any given year. And of course, they're measured all the time. But if you look at a portfolio that's tilted toward value and tilted toward small, over time, it outperforms large and growth. So now this has been tested many, many times. Actuaries have looked at it and found that small and value have a premium between 2 and 4%, and it is not a statistical anomaly. It's true to the 1,000th, only 1 in 1,000 times or less could it ever be just random chance. This is a real number, and it's been a true number since 1926. So when we build our portfolios, we're going to be sure to always tilt toward small and value. We won't just have that because it's the most risky of the asset classes. So we want to balance it off with others. So when they're down, others will be up, and our overall risk will not be as high. But any portfolio that doesn't have small and value in it is always going to yield over time less than what it would if you have small and value. If you're interested in our portfolios, you can always look us up on the web, and there's a way of contacting us at sheplergroup.com or sheplerfinancialgroup.com. That's our web design name, and I'm Harry Shepler, and it's nice talking to you. Talk to you later.